Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Seattle Investors Club podcast, where we talk about the nuts and bolts of real estate investing. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how you doing today?
Hey, guys. What's up? How you doing?
Yeah. Finally, well, I guess this podcast, I actually get to interact. So people probably heard our last podcast, and I didn't get to speak at all.
That's right. We are doing double duty today on recording our podcast because we are just so excited to have the two guests we've had on our podcast today. We couldn't wait. We wanted to get them all in on the same day. And Joe, we've been joking, is out in a sweat lodge somewhere or hanging off a cliff in South Dakota. And earlier today shoved his whatever connection line into his shoe or something. I don't know what's going on with you today, Joe, but I'm glad to have you back.
Yeah,
where are you
thanks. I'm in Custer, South Dakota, outside of Wind Cave National Park, which I have not been in yet. So maybe next podcast I'll have been there and could tell you guys about it, but don't know what it's like yet. Sounds like it's going to be spectacular though. And I heard that there's some fossils that we get to go see, and we'll see what else.
Awesome. Well, I think most of you guys know this, and I think our guest today, Enrique Jevons, also is an outdoor lover, outdoor enthusiast.
I am at that. Yeah.
Yes, he is. Maybe we'll get to hear a little bit about that. But Joe, for all of you, and I don't know if you know Enrique, but Joe is on a year-long or who knows how long trip and adventure across the U.S. in his tricked-out, awesome van.
I have seen that. Yeah.
Yeah.
Very
the
cool.
Fantastic Life. I'm leading the kitchen I'm leading the kitchen island bar life. That's where I'm hanging out at my kitchen in the island. I do have a beautiful view here, but Joe is leading the Fantastic Life, scooting around the country to all the national parks. So
very nice. Actually, I'm hoping to do just that. I'm practicing a bit. I do go to a bunch of different places, and my wife and I are actually talking about how perhaps of moving to either England, Italy for the summer for 3 months when our kids are out of school, and working remotely. So we'll see.
Yeah.
Ooh, that sounds awesome. Well, we have Enrique talking right now. Joe, why don't we introduce Enrique Jevons to everybody today? I think a lot of you listening know Enrique. He's kind of one of the staples around town when it comes to real estate and property management. But Enrique, do I have it right? You are the owner of Jevons Property Management. You're the managing broker at Pelago. Is that correct?
Yeah, so I'm the designated broker for two different real estate firms, and actually, three companies. For Yakima Valley Real Estate, and I have I think 6 licensees at the moment under Yakima Valley Real Estate, and they're doing traditional sales. And then for Jevons Property Management, and we have right now over 650 properties that we manage there. And then also I met up with Gideon, who owns Pelago. So Pelago being a valuation website, and he's the software engineer. And so I became then the designated broker for Pelago in order for Pelago to be able to conduct real estate transactions.
Awesome. So we know Gideon. We've actually had Gideon at Pelago on the podcast, haven't we, Joe?
Yes, absolutely we have.
Maybe we'll hook up, since you're involved with Pelago. Maybe we'll also connect Pelago's down in the show notes when we had Gideon on. But Pelago is a very cool platform for investors, like a research and deal analysis platform, as well as a brokerage. Is that a fair description of Pelago?
Yeah, exactly. So it's it's very similar to Zillow, except that it's geared towards investors. Awesome. So it's a free site, and you can go and check out properties, evaluate them run comps. It's got all sorts of calculators on there. So it's a very helpful tool.
And so now Pelago has a property management division. Is that accurate?
Mm-hmm. Yep.
And that is you. You are running the show.
Exactly. Yep.
Excellent. Right. So you can, Enrique, that's you are touching upon all the things, investor wise, investment wise, what a good setup that you have going on about, there in your world. So, I'll let Joe kick it off and ask you kind of our question we ask everybody from the beginning. So Joe, what do we got?
Well, Enrique, if you've listened to this podcast before, we really like to dig into how people were, brought up and what their background is, so that everyone can kind of understand that either we're all the same or we're all different, and, like to figure out who you really are. So if you could give us your background and how you got into real estate and all of the other fun stuff in between, we'd love to hear that.
Yeah, sure. So real quick, born and raised at Stanford Hospital, Palo Alto, California. So Stanford, and then I went to San Francisco State, graduated there, went into the hotel industry, and I was actually in the hotel industry for pretty much all my career up until 10 years ago, with both Hyatt Hotels and Marriott. I did also, in between those two companies, I worked for Stanford University for 9 years as a facilities manager for graduate housing. And so it's very similar to what I'm doing now, except that we had instead of tenants, we had graduate students. They would all move in, and then we would get places ready for them, move them out, inspect the units, and get the units all ready for summer conferences. Those usually 1 week stays. And so between that, my hotel career, which is essentially very similar to, you got guests that are coming and going on a daily basis instead of an annual basis like apartments, but it all has a lot of similarities together. So I was working my whole career. I worked my way up to becoming I was a general manager for the last 3 years of a Marriott hotel. And it was during that time that I thought, this is awesome. I made it to the top. I reached my goal. That was my goal of becoming a general manager in the hotel industry. And then I started listening to Kiyosaki and realized that, oh crap, I don't want to be an employee. I'm still an employee. I'm still making a paycheck. And one of the things that really was killing it was that weeklyism, signing the checks that accounting produced. Some of those checks were to the owner, and I was like, oh man, it's the owner who's making the money here, not me. And
right.
So I decided, no, I want to become the owner, and I would have very much enjoyed to have purchased a hotel, but that's just a bit much too capital intensive for me. And so I did the next best thing, which is to invest in apartments. And since the apartments were too expensive in Palo Alto, California, we have family in Yakima, Washington. My wife's family, we would come and visit every year. And so every year, one of the topics of conversation was real estate. And so as a result, we decided, we can actually buy a bunch of apartments in Yakima. We can also build a brand new, beautiful home compared to this old home we were living in Palo Alto. So even those, and nice home. It was 45 years old and $1 million, and much. As expensive as that might sound, it actually doesn't buy you a whole lot.
Right.
$1 million doesn't buy you very much in the Bay Area. So we were able to cash out. We had one other rental. We cashed that out too. Moved to Yakima, and it took off, went really well. Then 3 years ago, in 2015, we moved to Sammamish. And so it was originally Issaquah, so a lot of people know me as living in Issaquah, but it got annexed by Sammamish. So we're now living in Sammamish.
I love that story, because what's crazy is I'm a real estate broker. You're a real estate broker. I can't tell you how many people right now are talking about getting the hell out of Seattle, where moving somewhere, even Tacoma, actually moving to Tacoma, where they can have a better lifestyle and get bigger bang for their buck. Look at Joe. I mean, he took off into his van. I mean, we can't all do that, right? Especially with kids and things like that, or maybe we can. But I didn't know that. I actually thought that you were from Yakima and just grew your empire because you were Mr. Yakima.
Yeah.
I love it. You and I
7
are
years
actually
there.
neighbors because I'm from Alameda, California.
Oh, very nice. Awesome.
Well, I don't think we knew that about each other. I mean, we know each other, right? But we don't know each other that well. And I was born and raised in Alameda, California, which is San Francisco Bay Area, around that area. And just even when my parents, retired and moved up here and sold their house, which was a nice house, but the difference of what they could buy up here versus what they had down there, just amazing. So I commend you. I have a lot of respect for you and for anybody that actually will. Change is scary, right? To say I'm cashing out of my Northern California lifestyle and hotel industry and all that life and moving to Yakima. I mean, what a great decision that was for you, right?
It worked out extremely well. Yeah, it was a huge change for us.
How scared were you? Were you scared as shit to do that or what?
It was a funny thing. Yes, it was scary. When I actually pulled the trigger, then I was kind of hyperventilating as I actually resigned and then jumped in my car and took off and jumped on a plane and all in the same day. Because the unfortunate thing was I couldn't let on to the hotel that I was going to be leaving, even though I prepared everything in advance and had it all set up for them and did afterwards, talk to them many times to make sure everything was going well. But I couldn't let on to the mortgage companies that I was letting go of that income. I needed to have that W-2 income for the loans that I was obtaining on these investment properties. Yeah.
That is so interesting what you're talking about. We both know Albert Bowie, right? We've had Albert on the podcast, and that is such a hot topic. I mean, I love hanging out with Albert, and I know you are of the same mindset. Investors get in this mindset of, what am I going to write off? What I got to write off everything. I got to lower my taxable income, whatever. And I'm like, oh, really? Are you guys thinking far enough ahead that you might want to borrow some money? Please, you guys are missing the boat on that, right? I find, I don't know if everybody understands what we're talking to, but you just hit on like a hot topic for me about protecting your income so you can borrow, right?
Exactly. Yeah, you definitely need to do that. You need to make sure that you kind of overlap industries. So let's say you're a software engineer and you want to start getting into real estate. You want to start, the banks look at, your last 2 years, and they want to know that what you're getting into is something that you're experienced with. So you want to make sure you have a couple of years essentially of overlap. You're doing real estate for a couple of years at the same time.
Right.
You're still a software engineer, so that when you do decide to leave your job as an engineer, that you can claim that, no, look, I've already got documented income proof that I've been in the real estate industry for a couple of years, so that when you go to get these loans, the bank is going to be much more trusting of you, that you know what you're doing because you've done it for a couple of years now.
This is, I think, such an important topic. I'm talking to Albert. I'd like to get you on Enrique. This is the great thing about our podcast. We're here to talk to you about what you're doing in property management, but your mindset matches mine and matches some of the hand-selected people that I feel like we need to change the conversation on, everybody talks about wholesaling or flipping houses or whatever, but I am really getting focused in on understanding how to be an investor by understanding your debt position first and how to borrow money, and that you can do buy and holds from the start. If you know about creative financing, you understand your borrowing position, you understand how to move towards the faster lanes or better lanes for you to move into as a borrower. Needs to be such a part of the conversation that nobody, I think, is focusing on. So I'm going to invite you onto my debt team, I'm going to call it.
Sounds good. Yeah.
You up for that? Yeah.
Absolutely.
We're going to do something about that here in Seattle as a group. And I'd love to connect with you offline more about that so we can get a little kind of little dog and pony show going about that and talking about it more to help all our investor friends, right? But we'll jump back into the topic of today. So I love it that you had the cojones to make that move. I think because you had some family and some properties there before you made that move, had your toe in the water, it probably made it a little more comfortable. Is that accurate?
It did. Yeah. So that was part of the reason in moving specifically to Yakima as opposed to anywhere else was, yes, there was a little bit of a comfort zone there with it. But it is something that, yes, as you mentioned, talking about people moving to Tacoma and stuff, is that people definitely need to broaden their horizons and realize that you don't always have to live where you've always lived. You don't have to always do what you've always done, that you can start getting into, the surrounding areas where housing is more affordable, where the investments are more affordable, and then hopefully do what we're going to do, which is we've been, my wife and family, our kids and I have been taking a lot of 1-week trips. And so we'll work remotely from different parts of the country while we play around. And next week I'll be in California for a week. So I'll still be working, but I'm, vacation working type of thing.
That's awesome. I appreciate that. So let me just keep rolling on here. So we know that you're a smart guy making good decisions for yourself and your family. And now we understand how you ended up in Yakima. And now you're back over on this side of the mountains. What made you decide, before we get into the nitty gritty of all the other real estate questions, what made you decide to move back over to this side of the mountains? When you got it going,
compromise, yeah. One of the things that in moving to Yakima is then what after being there for a while, we realized that both my wife and I, having been born raised Bay Area, there is that culturally it was very different to go from suburbs to rural area with 3 kids. There, we wanted more for the kids. My wife was very active in the community in the Bay Area, and there was just not as much available to do in a rural area. And so for that reason, we decided we want to stay within the state of Washington, being, of course, because I'm licensed for the state of Washington. And Sammamish ended up being a great spot where we're able to jump on Highway 90. I can be back in Yakima to go check on the office there, to go check on properties there within a couple hours. So it's just a 2-hour drive over there. Yet at the same time, I can jump on 90, get into Seattle, check up on the propies we've got there.
And it's just a 2-hour drive there, right?
Yeah, about the same.
Right?
Yeah, because the traffic. Yeah. Fortunately, no traffic going to Yakima, so that's a nice thing. I never have to worry about that.
Well, that's awesome. Welcome back to the west side, I'll call it here. But so you're a real estate broker, obviously, as well as do you use you use that for your property management business and for your role that you play there also with Pelago. Do you use your real estate license in your personal investing business? Because how many units you own a ton of real estate yourself at this point, right?
Right. So in addition to the 650 some that we got going on in Yakima right now, that some of those I own, some I manage. I got 125 going right now in King County, Pierce County. Of what I personally own right now we're at 68. We were over 100 at one point. Well, actually, technically, we're over 200 at one point. But that was a mobile home court of 125 units. Yeah. That was I can talk about separately, a little side deal that we did for a year. Then we're at about 112 units for a very long time, but 54 were in partnership with 2 other people on an apartment complex.
Yep.
And they refinanced, paid me out of that one there. So now I'm down to just the units that I personally own. So these 68 properties are ones that I personally own, no other investors or
Got it.
partnerships
Is
on
that
it.
68 properties or 68 units? Maybe something.
Units, yeah.
Units, okay.
And they
Cool.
range from single-family homes to 13 units. 13 units is the largest apartment building I have, and I have been several 8-unit apartment buildings. I only have a few single families. Most everything I have is multifamily.
Nice.
90% is multifamily.
And why do you choose that?
For me, the more doors under one roof is just more economical. And so the greater return. So it is that I will seek out and buy as many doors as I can get under one roof.
Is that because of the way you're set up and your property management stuff, or would you recommend that for just even anybody who's trying to jump in the rental game?
The advantages are that they typically cash flow better. However, disadvantage is that they take longer to sell. So if you're buy and hold like myself, my goal is with all the remaining units I've got right now to hold them forever, never sell them, and just keep accumulating more and more. And so for that reason, I'm not worried about the fact that if I would want to sell any of them, that they would take longer to sell.
Right.
Single family homes, they're easier to sell because, in fact, then you get more people to be able to sell to. Not only, do you have investors that you can sell to, but predominantly you have owner-occupied individuals who are looking for homes for themselves. And so it's those will go faster, but they're just single family homes are hard to get to cash flow. I do use essentially the BRRRR method whenever I'm buying those, and even the apartment buildings too. I'm always refinancing because I'm always raising the rents. But especially on the single family homes, the only single family homes that I purchase have to be screen-in deals. They have to be essentially ones that I can come in, fix up, and then I just flip them to myself. Although Charles and other flippers won't, they say that no, it's not really flipping, but it feels like flipping. I'm doing all the same things they do.
You call it whatever you want, brother. As long as it's working for you. That's what I say.
Yeah, but I'm flipping it to myself. Then the bank is my buyer, except that I get to keep the property.
Do you have a rule of thumb on when you're refinancing, like that you want to be able to, your goal of refinancing, are you doing cash out refis when you do that? Is that your goal, is to get more cash out?
Yeah, I do cash out refis always. I try and get as much cash back as the bank will allow. All of mine have at least minimum of either 20%, mostly on the residential, the 1 to 4 units. The banks typically want you to have 20% equity, and so we leave that in there. The commercial loans, typically they want to see 25% equity, so we'll leave that much in there. And so, but oftentimes, no, I can get.
And when you say commercial, you're talking just more than 4 units. You mean
5 plus, yeah,
right?
5 plus.
You don't mean like an office building. You're talking about the fact that a loan changes from a residential loan to a commercial loan once you cross over 4 units.
Correct. Yep.
Yes. And so you're at 75 to 80% loan to value on your properties.
Yep.
Do you wait to refinance? Do you have like a threshold or a strategy, like you won't refinance unless you can pull out at least 10,000 or something's got to make it worth it? Because you know what I mean? You're not going to refinance. Yeah. You must have some thresholds. What are those?
I do. So essentially what I do is I do look for banks that will allow refinancing without a seasoning period. There are some banks, many of them out there, that will require, for example, a 1-year seasoning period. And what that means is they just want to see you own the property for a year before they will consider a cash out refinance. But there are a lot of other banks that don't have that requirement. I do on everything. I don't have any private money loans or hard money loans. Everything that I have is long-term bank loans or seller financed. I do have a bunch of seller financed properties, even 30-year seller financed properties.
I was going to ask you about that. How much of your portfolio have you purchased with seller financing? And do you find that is still a way that sellers is that still a way that you can get deals? I mean, of course you can, but has there been any slowdown, or has it always been the same and you just have to ask?
For me, it's always been the same. We just have to ask. About 10% of my portfolio is seller financed currently. And as a matter of fact, today I'm in talks with two different folks. I'll tell you their situations. One is the woman is, I think she's about 85 years old. She's owned these properties forever, and it's 5 units, five single-family homes on one parcel. We've been managing them since her husband passed away a few years ago, and she is, or actually, it's really her son, is saying, "Hey, these things are just too much for her, and we want to provide her with even more passive of an income. You know, would you consider buying or selling them for us?" So of course, jump in, yeah, I'll buy them. And since she wants passive income, how about we do a life estate with then seller financed? And so it looks like we're coming to terms on that. And so
nice.
I'm going to purchase that.
Is that on this side of the mountains or on the east?
That one's another Yakima one. As a matter of fact, everything I buy, I still buy in Yakima, even though I come across good deals in Tacoma that will are comparable. The biggest difference for me is that because I've got full-time inspectors, I've got full-time general contractor, full-time handyman that are working for me in the Yakima area, I can jump on things a lot faster. So the second person I'm working with, again, is a retired individual. He's had this duplex for years. He's been self-managing for years. And he said he wants to travel. And he doesn't want to have to think about or worry about the duplex. And so he initially started talking to me about property management. And then I said, well, he said, you know, sometimes he's not going to be reachable, but he doesn't want stuff being done. I said, well, how about I just buy it from you then? And he said, yeah, but I don't want to capital gains. I'm like, oh, I got the solution for you. Right. Then, yeah, let's seller finance, and you don't have to worry about capital gains. So those folks are still out there.
Though, do you help anybody, or do you get involved in 1031s at all?
Yeah, I've represented clients who've done 1031 exchanges, and so they just take longer. There's just more paperwork. You keep having to ask for extensions because the title companies and the paperwork just kind of drags on with those. But it's still a purchase like any other purchase.
Right.
Yeah,
awesome.
Rules to them, but
awesome. So, so you do seller financing when you can, as everybody should spend their time learning about seller financing, because even if you're a new investor, if you learn about marketing to even get deals and talk to sellers, learn how to talk to sellers, and you learn about creative real estate and seller financing, you can compete with anybody if you understand.
Yeah, definitely. I think people just assume that all sellers want to cash out, and that's not the case, especially for older folks. They don't necessarily want to cash out. For them, having a steady fixed income is much more important. That gives them a sense of security.
What kind of terms do you offer them?
Well, because I'm able to get bank financing quite easily, just because of my debt to income ratio and credit and all that sort of thing. So I always play that card against them, and I say, you know, I'm happy to pay it, or I can pay you the same terms that I would pay the bank.
Right.
And so I'll still get terms at 4 or 5%.
Wow.
Because I show them, hey, I can get this from the bank. So if you want to match it, awesome. Okay. So that's been working out well. So as a result,
so they're chasing you, right? You know, they're chasing you instead of you chasing them, right?
And that's always important too. Never fall in love with a property, and always be willing to walk away from a deal. Just because the deal comes across your lap doesn't mean it's going to be the last one ever. There's always going to be another deal.
Do you run into any thresholds on the borrowing? Isn't it like 10, or what are the rules there? Am I?
Oh, sure. Yeah. So currently the limit that the feds have is 10 residential loans. So residential meaning 1 to 4 units. So that banks can only lend you up to 10 loans, and that's across all banks.
And that's residential, 1 to 4.
Residential, yeah. And so that means those residential loans that those banks buy are conforming loans, also referred to as conforming loans. So they conform to HUD standards. And so those are loans then that the bank can in turn sell. And so they're only able to sell conforming loans. The other types of loans that banks will do are the in-house or portfolio loans. For those loans, there are no rules. You can have a bank can offer you as many portfolio loans. You can have as many portfolio loans as you like. So people should not get hung up thinking, oh my gosh, I can only borrow, or have 10 mortgages. That's only partially true. It just means you can only have 10 conforming residential loans. Beyond that,
what's the risk then? There's some extra risk with portfolio loans, but real estate is a risk reward game. But what are the risks with a portfolio loan that you don't have with a conforming loan?
Yeah. So portfolio loan and also commercial loans for 5+ units. The differences with those is the bank makes up the rules, and so they can make, which is good and bad, because then you can negotiate much more. You can come to terms that are going to suit both folks. Typically, those loans run 1 point higher on average than a residential loan, and typically those loans have a balloon payment. So they might be due in most common I run into is 10 years, but sometimes depending on the bank, it'll be 5 years. And so, but you can negotiate that. And so what that means is that the loan at maturity can
refinance.
You can either refinance it, sell the property, or pay it off. Most of the time, it's going to be a refinance. But if you're paying the mortgage every month, then they're going to be happy to refinance. And so it just means then typically the refinance is going to occur at whatever the market rates are at that time. So that is the risk to some people who, are hesitant about adjustable rate loans. They think, no, I want to have a 30-year loan and I don't want to have a balloon payment. For me personally, I don't worry about that because of the fact that I've never carried any of my loans to term, meaning 30 years, or in some commercial loans are amortized over 25 years. But I've never carried one to that long, and I never plan to, because I'm always going to be adding value to the property. I'm always going to be upping the rents, and because income properties, the valuation of those income properties is based more on the income that the property produces, so the rents that are coming in, versus like single family homes, which is entirely based on comps in the area.
Right.
So every time I raise the rents on my property, I have raised the value of my properties. And so for me, every 5 years is about what I do, and my plan going forward is I will refinance every 5 years my properties, because typically I've added a tremendous amount of value by then.
Right. So it just works into the program fine anyways, right?
Exactly. So even though, let's say 5 years from now, rates are up, you know what? If rates go up, that means the economy is doing better. If the economy is doing better, that means that housing, rents are going to be higher. So the fact that rates go up, that's fine with me, because you know what? My rents are going to be going up. So hopefully, even at a historically been at a greater pace than interest rates.
Exactly. Love it. So good. Such good info that anybody can get involved in this, and then the formula, in case we have borrowers out there that don't have extra borrowing power. Obviously, one option is to try and pursue deals with seller financing. But do you use the calculation of gross rents times 75% less PITI or whatever is what you're going for? Or how do you evaluate?
Yes, but I'll give you an even easier, because sometimes, with all the different formulas, there's so many calculators out there, which is wonderful. Bigger Pockets has an excellent rental property calculator. Pelago has an excellent rental property calculator. So you can go to these sites, and certainly there are many others that you can check out. But I'll give you an easy one. One is that I look for a property, and so I think it's kind of back to like flipping almost. I look for a property that is going to be, let's say the property is $100,000 to purchase. It needs no more than $50,000 in improvements that will then achieve for me a $200,000 after repair value. So take that, if you want to, if properties in the area are, let's say, $500,000 or $600,000, then you just make sure that, you times it out that way. So that, if you're going to put, for example, let's say you buy at 600,000, no more than 300,000. I can't imagine you're going to put in that much. And that would then, get you an after repair value of $900,000. So if you just use that kind of formula to,
is it a so you on your first
correctly
one
there with enlarging the numbers. If I buy for 500, no more than 250, of repairs to get you $1 million after repair value, that is huge money. Anytime you can get close to those percentages, it's going to make out for a good deal for you.
So I mean, in another way to say it is, if you spend half, 50% of your purchase price on improvements,
yeah,
right,
yep,
then you should be able to double your purchase price,
your
in
original
value.
Purchase price. Yes,
is that kind of what we're trying to say
here? Yeah, exactly.
Excellent.
So if you can kind of stay close to those numbers, that's going to be a really good deal for you. And then because you're going in for, let's say, $200,000, you get a $200,000 after repair value. So then the bank lends 75% of that. So now you've got all your cash in is all covered. And so now you can take all your cash and go do it all over again. And just continue that indefinitely.
So, I mean, you could calculate it both ways, right? You could use your method, and then you could benchmark it with the other method, which is, again, I'll repeat, which is gross rents times 75%, right? Minus principal, interest, taxes, and insurance. That needs to be a positive number that's left over, or a zero, to not have to use your personal borrowing capacity to qualify for that loan. Is that?
Yeah, so you want to get as close to zero. Sometimes I leave a trailing a little bit. I might have, $3,000 of cash left in a deal, really an insignificant amount. You want to get at least to zero, if at all possible. Anything that's positive, that's great. If you're able to get more money back on the deal than you actually put in, all the better. But if you could actually just break even, get zero, then that means you can take that same cash, do the exact same deal over and over and over again indefinitely, and you're leaving behind a trail of 20 to 25% equity in all these properties. So then pretty soon... And
having somebody pay down your mortgage.
Yeah, it's all being covered, all being paid, and now your net worth just keeps going up and up and up. As your net worth keeps going up and up and up, then your borrowing power, of course, keeps going up. And pretty soon, now you've got enough passive cash flow that you could just have somebody else manage the properties for you, and you're done. You can retire.
Now, this leads me to a good question transition here. What do you think about investors buying for, obviously, cash flow or appreciation? Is there a point where somebody should be buying for appreciation if they have enough cash flow from all their other investments? Or are you like, nah, that's not me?
No, definitely. If you have enough cash flow currently, let's say from your current job or whatever it is that you do, then yes, you can just look at appreciation. Now, appreciation is much more speculative. It's like buying, a stock. Let's say, you buy Apple stock. You're buying it because you're speculating on the fact that, okay, historically the stock has gone up, and so over a sufficient amount of time, it should continue to historically go up. So it is, it is a speculative bet, appreciation. And so you do need to take that into consideration. But if you don't need the cash now, then what that does is that's building up wealth for you. And so it will get you to the point where, you can retire even faster, because you can get to the point where you can just live essentially off of that passive income. So there are a lot of folks that if you're making enough cash now, there's no point in making more immediate cash. You can defer that cash because then you're not paying taxes on it, and just focus on creating wealth.
Right. I mean, that's a problem, right? I mean, the more money you make, ordinary income, the more money you're paying in taxes. I mean, I've owned enough property in my 20 plus year history to know, like personally right now, I'm lopsided, right? Because I, over the last 10 years, I've owned a lot of partnership on a lot of big apartment buildings, like 200 unit apartment buildings, right? Where I might own 10 to 15 or more percent. And we've sold those over the last few years, made a ton of money. That's a whole nother problem, right? If not exchanging and things like that. But now I find that I'm lopsided right now because I focused on getting some of my ordinary income built up so I could have my borrowing capacity intact.
Yeah, well, that's also one of the beauties about rental income is that rental income is taxed at a lower rate. So that's going to go on a Schedule E, which is taxed at a much lower rate than either, self-employment on a Schedule C, or of course, what's taxed the highest is a W-2 wage. So if you are able to, and that's one of the difficulties of flipping, of course, is that you're getting huge lump sums of money, which are taxed at capital gains tax, short-term gains tax, which is a lot more expensive than long-term gains, rental income.
Well, no, or flipping is taxed at ordinary income.
Or ordinary income, excuse me.
Right, which is is double worse than it's like the worst. So I think that's why people start out flipping, because that's kind of how the gurus and real estate educators teach everybody how to easily get started to make a quick buck, they think, even though they don't realize how hard it is. And then soon enough, they realize, like, holy shit, what's the point if I'm having to pay through the nose in taxes? I mean, I should be keeping these properties that I'm flipping. I should be, and so like, again, I am trying to change the conversation and the education path, right? I think people are educated about things in the wrong order. And I am building a gang, which I'd like you to join, that is going to help change that conversation. So if you guys are listening, stick with me, because I'm building a gang of smarty pants, selecting people that I know understand the conversation that I'm trying to have. And I need to be talked to myself. We all need to learn. I could talk to you, Enrique, all day long.
Oh, well, that's why I go to all the meetups, is because I'm constantly learning. So to think that I know it all, no. So I'm always super excited. As a matter of fact, when I moved here 3 years ago, and I started attending all these meetings over here, where people are doing all sorts of things. There's notes and flipping and and investing in larger, buildings, syndications, and there's all these different avenues of ways to make money in real estate, which are very exciting. For me, I'm a very conservative person, and so I just fall back on each time what I know and enjoy, which is the rental property business. So I of course, am always promoting that, but no, there's plenty of people also that are killing it, with other ways, and I really enjoy meeting those people at the meetups, because I learn so much from them.
On all that, don't you think that everybody needs to understand their borrowing capacity as a fundamental start? You know what I mean?
Yes, you really, yes. And I always keep encouraging people is go talk to a banker, go talk to hard money lenders, go talk to private money lenders, and find out what is their criteria. And then you can set a goal. You can realize that, oh, you know what? Okay, it might take me 1 year, maybe it takes me 3 years to get to the point where a bank is going to be willing to lend to me at these great rates.
And what am I going to do in the meantime to move myself into that lane? That's the conversation.
It gives you a goal. It gives you a path, that you can move forward with. Because if you have no idea,
they have no idea right now. They have no. I think a lot of people have no idea. They're like, I'm going to go to wholesale. I'm going to flip houses, but they don't understand that after doing that for a little while, they're going to, want to move on and grow past that. And what I'm saying is, we need to teach them from the beginning how to identify how to get on that path. Because I think the focus is on the wrong focus, right?
I think yes. You definitely want to talk to, to people who are truly experts in that particular field, people who are doing that specific thing for a while. So if you want to go into wholesaling, don't talk to a flipper and find out all the reasons why the flipper didn't go into wholesaling. No, go talk to the wholesaler who's actually doing it really well and who has a very good track history. See if that's something that you really want to get into. Maybe it is, because there are different passions for different people. So there's plenty of people out there who hate landlording. The last thing they want to do on earth is talk to a tenant. And actually that's kind of, for me, I've kind of burnt out on talking to tenants, but that's okay. I've got staff who can do that for me now. So, how do
you use your real estate license outside of what's required for your,
Well, the crazy thing is, it wasn't that I really wanted to, get a real estate license. It's that I was required to, because you could have 6,000 units of your own and not need a license.
Need one, but why would you not want to have one? I guess if you're in the real estate business, to take advantage of being able to buy at a discount, I'll say, because if you pay yourself, if it's listed. I mean, if you're doing off-market stuff, then of course that's a better deal and a better way to buy. But even like, I look at it as a real estate license as a discount card and as an insurance card. It's a discount card when I want to buy. It's an insurance card for me when I sell. If there's some trouble, then I can save myself a lot of money by selling it, there's definitely no reason to get one. I mean, not get one. So, but I initially got it because, to manage for others. So if you want to collect rent from your next door neighbor while they go on vacation, you need a real estate license because you are holding their money, their funds, and that's what triggers the Department of Licensing if you are, taking money for another owner. So you need that. But it's so much cheaper to get a good education with real estate by going through the whole licensing, classes and programs. So you take 90 hours of real estate, courses, which can be done online. There are great online websites that do give you course credit for, towards your real estate license. It's very inexpensive. And then take the test again. It's not very expensive at all. We're only talking, hundreds of dollars. We're not talking thousands of dollars. I think it's crazy. If you want to be in the real estate business full time, you're so excited about it, yet you don't want to have the number one tool that, get you access to inventory, get you discounts. We can talk about that till we're dead in the face, but I'll save that for another day. Let me ask you, what do you think about out of state investing, which seems to be this huge topic? I can't tell you in the last year almost how laughable and comical it is, how many people all of a sudden want to be buy and hold investors. They just like flip a switch. I'm going to be a buy and hold investor. Now I'm going to start investing out of state. That can be good, but I don't know. I've always found it questionable because I'm probably too conservative and a control freak. What's your take?
Yeah, and that's kind of where I'm at too. So I get that question asked, all the time. It has been a hot topic as of the last couple of years, it seems. A lot of it is certainly, I think, websites like Bigger Pockets and such are, you get a whole lot of people talking about different parts of the country. And it definitely is very good to invest in other areas where you can make a much better return on your money. However, for me personally, again, it's kind of back to why do I keep mine in Yakima? Well, it's because I have my system set up. I have my staff there. I have an office there. I have folks, general contractor works full-time. I have handyman. And these are all people that I know and trust that worked for me for years. And so I know that first of all, I can jump on deals real fast, because as soon as I catch wind of something, I can call my inspector and he's going to be there within the hour or two, and he can go.
But
and
I
inspect the
realize,
property.
so that's you, because you have it
Yeah.
dialed, right? But I
Right.
know people want your advice in general, just because you're the man on, if somebody's not you, if they're just
So if they
they're not
want to,
you and they don't have a crew and they have to hire property management or whatever, are you a believer that, investing out of state can work? I mean,
yes. So
what would you be looking for it's obviously you're looking for great criteria, but is it that you'd have to go there and hardcore interview property managers, or what do you think would be something that would be a safe way, or what's important other than the numbers on the deal? Okay, we all know that. What else would be important?
Okay, so hiring. So then essentially what you're doing is you're hiring people who are out of state, and so what you need to do, it's very similar to like hiring an employee. So if you're working in a company right now where you have to hire employees, my take on it is you got to do the exact same thing. So you want to make sure that the real estate agent, the property manager, the contractor in that location is somebody that you can trust, and not only trust, but you're going to have to make sure to follow up on them, because otherwise, if you don't, you take your eyes off of the steering wheel. I mean, they may be very well intentioned, but all of a sudden they're just going a whole different direction than what you had envisioned. So it does require, in my opinion, it does require flying out to that location, becoming familiar with the area, so you can research it from afar, and so that's fine. It's just important, in my opinion, to research it from afar, to make sure that you're working with people who are not new, that they're very well established and have been, have a good reputation, that you do get referrals, that these are people that are trusted individuals, and start.
How about unannounced visits? Don't tell them you're coming and
yes,
be like,
so
I'm here today.
Yeah, all your visits should be unannounced.
That's
And
a tip for you guys, unannounced visits. And how about having something in your property management contract about penalizing or getting out of your contract if they, or something?
Yeah, any contract, any agreement is obviously, there is no specific standard. I mean, any contract, you can write anything in. So whether it's
are property management contracts month to month, or are they annual?
Well, we do ours to start with annually and then go month to month. And I would say that's what most property management companies do. Although if somebody really is unhappy, we would, of course, let them out within that first year. But for us, because there's so much work up front, we don't want to have somebody hire us. We, place a tenant, we get everything going great, and then they say, this is awesome, and then decide, I'll take it over from here. Well, now we've spent all this money up front and haven't been able to recoup our costs yet. So that's why it's important for us as a management company to make sure we start off with at least a year. After that, then we're fine with it continuing month to month.
So what's Appfolio? Is that something? I know you're a technology guy, and that makes you unique in the property management scene. You use a lot of technology and VAs and stuff. How do you benefit from Appfolio? Or if somebody, now you all know that Enrique and his property management company are available for you guys if you guys have rentals that you have right now. Would that be through Pelago, or would that be through your own company, or how does that work?
Well, we're operating currently as Jevons Property Management within Yakima County, and then anywhere else in the state under Pelago Property Management.
Okay,
but
got it.
It's honestly, it's the same staff. Yeah. It's just two different names on the front end. That's it. But yes, technology is wonderful to use because it is such a relatively low cost. So anything that you're doing within real estate, I highly recommend using technology to your best advantage. And that goes also for, and I'll get back to Appfolio and such, but that goes for if you're managing, you want to buy stuff that's out of state, is make sure that you're working with a property manager who is very technology enabled, and that is a person who's comfortable with, for example, using Dropbox, using Google Drive to be going out there, inspecting the property, dropping photos and into either one of those drives.
Digital communication.
Exactly, because that's how you're going to check. Of course, yes, you can annually go out there yourself, but in addition, you don't want to let too much time pass by. You just occasionally ask the property manager, say, hey, can you run by my property and shoot some photos for me? I want to see how it's doing right now. And so, that's something that's easy to do, an easy way to check up on your
What
prices.
are your favorite apps that you...
So what I'm using, as you mentioned, is AppFolio. So AppFolio is a property management software solution. It is a software that we use to manage all of the properties. And so because of the fact that it has an accounting component, it has a maintenance component, it has the applications to be able to track the tenants, the ability to track every single conversation with the tenants. So all of our texts and emails, everything is done through AppFolio, so it's all recorded.
Is it something that you'd only want to use if you had a certain size portfolio, or can the person that owns 5 rental houses use it?
So the thing of it is the premium software out there. So I mean, it's the most expensive. It's the most robust, but it's also the most expensive property management software out there. So it starts with 200 units. So if you have less than 200 units, you can still sign on with AppFolio, but they will charge you that 200 unit minimum. So it does become...
do you have a starter version of something that's like AppFolio, but not AppFolio? Like in Joe's world, my partner Joe's world, Joe's still here. He's just hanging off the wood, guys, while he's listening. We have Infusionsoft, right, Joe? I mean, and Infusionsoft is the robust, more expensive version of what Infusionsoft is used for. It might not be appropriate for everybody to use it, because it's... What do you have in property management that you might recommend to the smaller time?
Sure. Buildium is another one that's out there. So Buildium, you can check them out. They're geared a little bit more towards the the smaller, but still has a fair amount of units, and so it's a little bit more of a affordable starter platform. There is also a free. So if you've just got 1 unit, this is what Grace uses. As Grace is taking care of all the rentals that they're starting to accumulate. Grace Yarber and Tarl, and that is. Now I'm trying to blank on the name. It'll come back to me in a moment.
Well, don't worry about it. It'll come to you when we're talking about something else. I'm going to side note to Joe and say, see, this is why we should have affiliate links like to Buildium and things like this on our, what Mitch was talking about. You know what I mean, Joe?
Cozy.co. So they're
Cozy.
COZY.co. So cozy.co, that's a free site. The way they make their money is off of the tenant screening. They charge the tenants for that. And so...
And people are using that for screening. I've heard a lot about that. I've actually gotten some deals sent to me, with Cozy Co stuff on there. So Buildium, Cozy Co.
Yeah, small company out of San Francisco. And so they are, it's a very simple thing, but it does have, it's a great starter for if you've got like 1 to 10 units. Over 10, you're going to grow out of what they have to offer. But if you've got 1 to 10 units, that's where I highly recommend you start, is a free service like cozy.co.
And then maybe move into Buildium until you're like a baller, like
until you get a couple of hundred, and then,
What do you use when you're looking for rental comps, Enrique? I know you obviously in Yakima, you probably know off the top of your head what something's going to rent for.
That's also part of it. Yeah, you can just give me an address.
Yeah, right. But what about property? What would you use over here for like Tacoma or whatever? What would you use to comp out rentals?
Yeah, well, one thing, certainly Pelago is a great free valuation website. So there's...
Let me ask you though, does Pelago have rental comps? I mean, Pelago is an evaluation tool for properties on calculating whether it's a good deal or not. But are they also a can you run rent comps off Pelago?
It does have a rental calculator, but honestly, there is no great site out there for the
Not like
valuation
Rent-O-Meter?
of rental properties. Yeah, well, okay. So, let's talk about a few of the big ones. So, Rent-O-Meter. Rent-O-Meter, the way that Rent-O-Meter works is that it asks you for, the property that you're interested in. You have to tell it
how many
that
bedrooms?
property is renting for, being advertised. And that's how Rent-O-Meter aggregates all of its data, is that every individual puts in what they're renting that property for, and then it figures it out. However, the problem with that is then that data becomes very antiquated very fast, because, maybe somebody put in, what it was renting for 2-3 years ago.
Right.
And it hasn't been updated since. And so you've got old rents in there.
Does Rent-O-Meter not sweep like Zillow or anything like that for rental numbers and addresses?
It can only, and the same applies with Zillow, is that Zillow will pick up everything that's available for rent that's essentially posted online. And there's a lot of other apartments.com.
Garbage in, garbage out.
Yeah, and so, but the difficulty is that it's only grabbing what the rents are being advertised. And so, for example, you get somebody that is advertising a place for rent for $1,100 a month, and then they rent it out. But you don't know what they actually rented it out for. It's just
right.
That was the advertised price. And then, if you hold on to a property, as many people do for years and years, the tenant doesn't move out. Well, the tenant's rent may have been increased every year,
right.
But Zillow, Rent-O-Meter, Apartments.com, none of these sites are going to know that, because there is no reporting feature when people give a rent increase to their tenants.
Right.
The only reporting feature is when they advertise for rents. And so that's the difficulty.
I've been looking sometimes at, just because I used to do a fair amount of business with these guys, and they own a lot of properties. I'd go to the Invitation Homes website, and I'd see what they're offering for rent wherever it is I'm looking for a rental. And see what their current asking rents are, because they have so many properties, right?
Yeah.
So that's kind of one part. But so are you basically saying, well, where would you go? Like if you weren't in Yakima, what would you look at?
Zillow is still going to be a very good site to take a look at what stuff is renting for. So you can take a look at Zillow.
Are you looking at what's actually for rent, or are you looking at the Zestimate on Zillow for that rental?
You can look at both. The Zestimate is going to be kind of a trailing figure. So meaning that if the market is moving up in rents, then those numbers are typically going to be lagging behind, because it's just going based on, what historically people have been advertising for. And the same then goes when the market starts going down, those rents are going to be artificially high, because again, it's
a lag, it's a trailing.
There's a lag to it.
Good insight.
Now, what we do is Appfolio, one of the beauties of being, part of using their software, is that Appfolio has actual numbers of what is really everything is being rented for from Appfolio clients. So because it's the leader in the industry as far as property management software goes, what we are able to do is put in an address, and it will tell us what all the comps are, meaning all the similar places for rent of Appfolio users, of which there are a ton of Appfolio users. And what's nice about that, that's not advertised price, that's actual real-time today rents.
You guys at Pelago, and maybe you already do this, you guys should offer...
pull the data. Yeah, we haven't figured out a way. Unfortunately, Appfolio is closed API for those in the software industry.
No, but your team literally could plug it in, right?
You could manually plug it in. Yeah, you could manually take the numbers and plug them in.
Right? So if somebody's a client of Pelago's property management, which is Enrique's property management, you will get the benefit of if you're searching for new deals, or you have an off-market deal and You're probably going to let Enrique's team manage it maybe or something. You have the benefit of using his Appfolio login. I guess I would say they'll do it for you, of comping that property you're looking at buying. Is that
we do it for them and we'll comp it. And that is the funny thing too, because I get owners that call me all the time and, how much is my place rent for? And I can just very quick, I just look up on, in our database, and I'll tell them, this is what I think. Oh, no, you got to see it. You got to see it. I'm like, no, I don't. I go, the data doesn't lie. It's yes, maybe if yours is a little bit cleaner, a little bit nicer, great. It's going to sway the difference, by $100 or so. But
are you able to run reports then off that, like where you can see sort of trends in rent or any sort of reporting data stats?
Mm-hmm. Yep.
Dang, guys, that's like, just for that reason alone, if you're a buy and hold investor and you're doing that's like right there by itself. We all love Enrique and, we all love Pelago. And that's like a reason why you'd want to be involved just as it is. Enrique, do you think that right here, forecasting forward into 2019, are rents going up or down or even or what?
No, rents are coming down right at the moment here for the state of Washington.
Why is that?
A couple of reasons. One is that the supply is finally catching up. So developers always lag because it takes time to get permits, and it takes time for developers to, gain.
So all their units are coming online now, right?
There's a ton of units coming online.
We have an absorption issue.
Exactly. So that's the thing, is that you've got a couple of different factors. One is that as far as hiring goes, we went through a huge hiring spurt with, especially with Amazon, but certainly with others. And so you get this huge hiring spurt with the supply not having caught up just yet. And now the hiring is kind of starting to taper off a little bit. They're still hiring. It's just not quite at the same pace that they were. And now you got thousands of units that are coming online everywhere. And so as a result, yes, it's an absorption issue. So over the next year or so, it's going to take a while to absorb all these new units that are coming online. So rents are going to start to taper. Well, they already have tapered off, and they are starting.
When we say taper off, are we talking like 10%, 20%, 5%?
Yeah, right now we're just talking very minimal downward trends of less than 5%. And what I've seen historically from being in the business is that the swings in rentals are not as great as the swings in sales. So whereas I'm starting, for example, to see on the MLS a lot of people backing off of their sales prices, they're actually starting to have some price decreases, right? Yeah. So so what I see is that, for sales stuff, it goes up at a faster pace and it comes down at a much faster pace too than rentals. Rentals, they don't increase quite as fast. They don't decrease quite as fast is certainly been my experience. Even though, you can adjust it immediately. A lot of people, what they'll do is they'll do concessions instead in order to try and keep the rent up. They'll do a concession, whether they will. Well,
because it affects it. If you drop your rent instead of doing a concession, it immediately impacts the value of your property on a commercial sized loan property, right? Because your NOI dictates your borrowing power. And if you cut your rents.
Yeah. So the last thing you want to do, right, is cut your rent. So there are other things you can do, concession wise. So everything from, you offer lower move-in costs, a lower security deposit, or you tell them, hey, I will repaint the place for you. I'll put in new carpet. I'll put in a ceiling fan. I'll put in air conditioning.
Right.
So there's a lot of other things you can do besides dropping the rent, and that's what I always recommend.
Let me ask you. So this absorption issue that we have, which means that there's too many new apartment buildings coming online that are competing, and they're having to be more conservative or give away things that renters are looking like, oh, if I can get in that brand new building, I'll get in there. How, does that impact? I know it impacts other multifamily properties, but does it impact single family, or is that a different person, a different tenant who wants to be in single family rental home versus an apartment?
Yeah, there is still an effect. So, for example, with most of these units that are coming online, we're talking about a lot of large high-rise buildings. You see all the cranes in Seattle, for example. A lot of these high-rise buildings that are coming online, and that's how you're getting thousands of units that are coming online. So they still have an effect, because what happens is those people got to come from somewhere. And so, granted, maybe those smaller but higher end units downtown, they're going to attract a younger clientele that likes that type of building, better. But that younger clientele had to have come from somewhere. So they might have come from the suburbs. And so maybe they were living previously in Bellevue, for example, and now something's opened up that they like in downtown Seattle. They move. Okay, so now something, they might have previously been in a single family home in Bellevue. So now that single family home in Bellevue opens up. Okay, so maybe somebody from, Issaquah now moves into that one, but now then the values in Issaquah drop as a result. So it is this kind of, domino effect that does happen. And so, yes, single family homes.
As people have an opportunity to get into closer in town to these urban village locations, especially all these younger people, maybe they were off renting houses out in the burbs somewhere with their friends. Now they're like, oh my God, guys, we can move into the city and get a swanky brand new apartment. So we're going to move out of our rental house. Right. And so the trickle down,
it does. So there is a trickle down effect.
And the thing is they're signing a year lease. So that's a year's impact.
It is. And so that's where, that's where an apartment building is going to be much more likely to offer concessions. Much better for them to offer, for example, the first month's free rent, because that does not devalue the property any. Right. They're able to get somebody in, and at that higher rate, they can show that to the bank that what the rents are. So
right. I hope you guys are listening. For anybody that owns a rental properties with that are how many units? Does it even a duplex? Is that counted off of? Is a duplex loan, Enrique? Because it's considered a single family loan. Is that calculated off comps or off NOI on just a duplex?
Mm-hmm. So it depends on the bank, and so on the lender. So for example, credit unions will oftentimes base all non-owner occupied properties as essentially the same as commercial loans, and so
which is what we want. I mean, which is
because it is, and it's not. So it depends, because it might be a little bit higher interest rate. So they will consider than even a single family home that's non-owner occupied. They'll put a higher interest rate on it, because there is people, if they're starting to bankrupt out, they're going to let go of all the income properties first and protect their own primary residence. So the primary residence is always the safest for the bank. So they might charge a little higher interest rate. However, they'll value the property based on the rents, and they typically you can get a loan sometimes a little bit easier, because they base it lending you the money based less on your debt to income ratio, which is what is of primary importance in buying a primary residence for yourself. And they base it more on how much money that the property generates. So
let me ask you though, is there a balance? Let's say you own in the 1 to 4 unit category. So technically it can be considered single family, right? Not commercial, because we're 4 or under. Now, people would like to have a residential loan because the interest rate is maybe a point lower. But
So
what
as
you
long as
need
you
to,
qualify, yeah, as long as your debt to income ratio is still within that bank's standard. So a lot of times it's like a 40 some percent debt to income ratio. So, but each bank, is a little bit different. So that's why it's always important to have these conversations with your
but
bank.
is the downside of that though, Enrique, is that if they're only valuing it off other single family comps or other comps, you might have limited market value, which your loan is going to be, 75% of that versus maybe you have to pay a point higher, right?
Mm-hmm.
But you're valued off your rental income, which might calculate to a higher value.
Yep. So higher
there's a
valuation, which means they're going to lend you more money,
right,
and it'll be a little easier
so
to
you'd want to
borrow.
look at both, like
You definitely do. Yes.
right.
So you definitely want to look at both. So it's always best to have, if you're, you're looking at a 1 to 4 unit, that you are shopping around. So you're going to go talk to various banks and you're going to say, here it is. What are your terms? You go to the other bank. Okay, here it is. What are your terms? And you will find that there is a big difference between banks, and banks also. So for example, with my properties, I have 4 different banks that I consistently use all the time, but I'll send the deals to all 4, because just because I borrowed from one bank one time doesn't mean this next time they're going to have the best rate, even though last time they did, because banks kind of also go back and forth. They can only lend out, that is, a certain percentage of their assets, of the money that they have. And so sometimes they're offering incentives for people to open up, savings and checking accounts with them. And then sometimes they're offering incentives for, to get loans. And that's because they've got this kind of seesaw going back and forth, just like anybody else, of sometimes they're flush with cash and sometimes they're not, they're tapped out.
Do the banks know, they can't see that you're shopping them? I mean, they might know because they know you.
I tell them. Okay. They know who, because all of them have my portfolios, so they all know who I'm borrowing from. And I've also told them what the terms are. This is what terms I'm getting from this bank, because they will compete. Sometimes they just say, oh, no, that's, for what we've got available right now, this is our best and final offer. And sometimes they're like, oh, you know what? No, we'd love to pick up that loan from you. No, yeah, we'll match their rate. We'll do that.
Who, if I don't know if you want to share this or if it's okay, but if you don't want to, then don't do it. But who are your favorite banks or portfolio lenders? Because those are 2 different categories.
So my favorite banks, the ones that I'm using the most of, I still have some loans with other random banks, but the ones I use the most are Banner Bank. I used them especially when they were just the state of Washington. Now they've grown a little bit. They've acquired some other banks, and so they're now in Idaho and Oregon. And so they're starting to get a little bit bigger, but I've always liked them. Another one that's doing really well for me lately has been U.S. Bank. So U.S. Bank has given me some great commercial terms. And so I'm using them for, Banner is, for me, it's best with the residential loans and portfolio loans. U.S. Bank has done best for me with commercial. Also, Giza Bank. Giza, nobody's ever heard of, because they only have 5 branches that are based out of the Tri-Cities. They're brand new. They have no idea what they're doing, so it's a little bit frustrating.
Giza? How do you spell it?
Giza's Gesa. It's an acronym for something. The poor guy. It's like pulling teeth to get information out of the banker I was using, but the rates were really good. So I did use them a couple of times, even though my wife kept telling me, don't use them again, don't use them again. He's so frustrating to work with, but it's like, the rates are good. So that was one that has worked out well. And then the other for me has been Celerity Credit Union. Celerity Credit Union, again, that's a bank out of credit union out of Yakima. And again, the drawback is the closest branch they've got is Ellensburg. So they just only have Central Washington, but they also only lend essentially in Central Washington, which means that there's not a whole lot of, it's easier sometimes to borrow money from them because of the fact that they don't have a whole lot of investors in that area. So,
how about if you were going to do a refinance of your personal residence? Do you have a favorite bank that you would go to on that?
Yeah, so for me, personal residence I did do with Banner, so that worked out well. But I've heard wonderful stories about Boeing Employee Credit Union, so BECU. Yeah. I definitely, I'm open to giving them a try because I've heard wonderful things about them. Also, I've heard great things about Home Street doing personal residence loans. So I would say, find a bank that's in your area or where you want to buy. So, and if you're buying then in Michigan, don't get a Washington bank, go get a Michigan bank. Try and find this, start working with the smaller banks. I find that they're just much more accommodating. They are much more open to smaller loans. When you're working with, and I've had accounts with both Chase and Wells Fargo, and actually I still do. But Chase, Wells Fargo, Bank of America, they only want stuff that's 5 million plus. I mean, anything less than that to them is chump change. So in my experience.
How about with HELOCs? Like a lot of investors might use a HELOC to get started with some of their equity needs and things like that. Would you go to these same banks for the HELOCs?
Yeah, I've got a HELOC with Wells Fargo, with Banner Bank, and I've got an unsecured line of credit with Giza, and an unsecured line of credit with Celerity. So the secured ones, the HELOCs, offer better rates than the unsecured ones. Although Giza, I've got an unsecured line of credit, a really nice one at only 6.5% interest. So that one's $60,000 that I've got with them. And hey, $60,000 that I can use as a checkbook, only at 6.5%. That sure does beat, a hard money loan or even private money loan.
Does it affect your borrowing capacity if you've got like a line of credit or a HELOC out that has a zero balance on it?
If it's a zero balance, that's a good thing, because then that means that you're using a smaller percentage of your borrowing capacity, and that's important.
They won't count when they look at your borrowing capacity. They won't count that you have that available to you.
Yes. So some banks will certainly count that, and that's where commercial loans start to play in a little bit better, because commercial loans don't worry about that because that's on your personal side typically. Although I have both. I have lines of credit on my personal and lines of credit on my business side. So all very good questions for bankers, and why you want to make sure you establish a very good relationship with a banker, because every bank honestly is different on what they place their emphasis on.
I want to say that I could talk to Enrique forever. And I know we all need to get going on here today. It's obviously very clear to everybody who's listening, and I will listen to this over and over and over again myself, that Enrique is just super experienced, a wealth of information. He's up to date on all the technology. He has all the insight and access that you might want in regards to rental information, banking information. Pelago is super cool as a platform for evaluating your real estate deals and deals that are listed on the MLS. Does Pelago pull any for sale by owner stuff? Like, how like Redfin has that on there?
If they put it in, yes, but for the most part, it's MLS listings at the moment. Yeah.
But Pelago is free. You just have to sign.
But it's free. Yeah. So it's a free site. So there's no reason not to. So then you can go check out all the sites to get you a good comprehensive valuation of. Make sure you connect, of course, with a real estate agent so that you're getting a portal into the MLS. You can still check, with Zillow and Redfin and Pelago to see, what each player says, because the truth is somewhere in there.
Yeah, well, Pelago, everybody needs to check out Pelago if they haven't done so, because it is a very useful. It's like a cheat sheet, guys. Yes. You want to check it out. Enrique, how can people reach you and how, there might be people out there that are interested in property management consulting, and in general, what services would be your main service that you're offering? Would that be the property management side?
Yep, on the property management and also buying. So if you're interested in buying multifamily, I have access to the MLS, but I also, because I'm managing properties for over 175 different owners, there are a bunch of them that, they're just getting older. And so they're happy to sell. They don't want to go through the hassle of listing it on the market.
Right.
But there's a lot, so essentially they're pocket listings. So I've got a bunch of pocket listings because these are, people that that own properties, and they're happy to sell them. Yeah.
I have a exchange need right now for Tacoma. I need to get into Tacoma, exchanging out of the Seattle area. Do you guys have some properties in Tacoma that I can talk to you about offline here?
Fourplexes, if you're interested in fourplexes, yeah.
Okay. Well, I'll hit you up off outside of this. That works. That works. And so what would be the best way for people to contact you regarding rental property management or interest in, picking up?
Emails.
Please, guys, don't contact Enrique just to see what he's got. You need to be serious and ready to buy. You don't just come on, let's be honest and let's be cool here, okay? People, people do crazy things. So we love you guys, but please use your brains and your professionalism when we are saying that there's secret sauce and ninja information. You don't just go gather it up. You only make that happen, and don't waste anybody's time unless you're really going to go buy something, right?
Yeah, no, it's very true. Yeah.
Right.
Yeah.
But
so email is great for me. So if you want to reach me at Enrique@jevonsproperties.com. So ENRIQUE, my first name, at jevonsproperties.com is my email address. So JEVONSPROPERTIES. Now, if you forget, all you got to do, I'm the only Enrique Jevons out there in the world that I know of. If you just do a Google search, you will find me. So you can also find me on Bigger Pockets and other places as well.
Well, awesome. I look forward to getting you in my gang of, kind of some new stuff that I want to talk about if you're up for that.
Well, I think that's important for everybody. I mean, everybody should have their, group of people that they can get together with and
and then we're going to share it, But I'm saying we're gonna get all these smart people that I'm hand selecting together, and then we're gonna share it with our tribe.
Sweet.
And our tribe is anybody who's listening, wherever you're located. This stuff that we're talking about applies to everyone everywhere. It doesn't just apply to Seattle and Tacoma and Yakima. What we're talking about applies everywhere. So spread the word on what we're doing over here at Seattle Investors Club to your friends and family across, whoever wants to learn about, how to do things better or insider information. Let's all share with each other. People like to do business and help out other people that they know and like. And we love you all. So let's do it. Joe, hit us up with the details.
Yeah. Good to hear from you guys. Great stuff today. Everybody can get a hold of the show notes by going to seattleinvestorsclub.com/46. And I've put all of the links that you guys have been mentioning today in the show notes. So if you'd like to get a comprehensive list of everything there, including the banks and Pelago and all that fun stuff, just head over to seattleiinvestorsclub.com/46. And if you wouldn't mind, we love reviews on iTunes. That helps us to get our show out there to more people. So head over to seattleininvestorsclub.com/iTunes and just know that every 5-star review that we get helps us a ton.
Hit us up. Right on. Excellent. Well, thanks, Enrique.
Thank you guys. I really appreciate it.
Spectacular. And I am excited to borrow money and buy properties and all that stuff. It just talking about it makes it seem almost less complicated, It doesn't have to be that complicated, guys, especially if you have teammates and people you can call. So we're here for you. And that's all I got. Over and out. And we'll see you next time.
See you guys later.
Thanks. Take care. Bye.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.